fund thesis really comes from my background and John, my co-founder's background. We both worked in private equity. I worked in mid-market private equity, buying up companies in the US, and John worked in real estate private equity. But both of those jobs, especially in the mid-market, are based on cash flows of companies, because you're not buying a stock that you can sell in 3 or 6 months, and you can't really play a narrative if you're planning to own something for 5 to 10 years. So the whole job becomes about predicting cash flows, predicting kind of main drivers, and thinking about, what do I get for holding this asset? And when we came into the industry, we realized that was not the prevailing mental model at all for investments. It was really a kind of a greater fool model, where you say, I'm buying this because I think there is some narrative that's going to double or triple it over the next 6 months, and someone else will buy it. But why are they buying it? To sell it to somebody else, and there's no kind of end to that chain. So, one of the things that you really do on this podcast is talk about first principles constantly. Our view is first principles are, for an asset, are what do you get for holding it, right? You're trading US dollars that you can pay rent with for an asset. Is that because you think you can sell it to somebody else, or is that because that asset will give you cash flows over time that are more than worth the trade? And we think the latter ends up winning over a long period of time.
Felipe, thank you so much for coming on the podcast.
Thank you for having me on.
Appreciate it.
This is my favorite podcast, so it's good to be here.
No, thank you. I appreciate the kind words. Excited to do this in New York, running around the city. I'm sweating a little bit, but all part of the New York lifestyle.
It's been the hottest day of the year, I think.
It's good though. I'm really excited for Stanford blockchain conference. It's one of my favorite. I was a little sad it wasn't in Palo Alto, but I don't know. If you had to pick any other city, New York's a great place to host it.
It'll be my first time, but It's nice to have it nearby. And Columbia's a good venue too. I went to TLDR, the DeFi conference there. Yeah. It's just a nice place where everyone can meet up outside. It's a good blend of attending the conferences and also just meeting people that you haven't seen in a while.
Nice. No, I'm definitely looking forward to it. We're early in the week, and so should make for a great venue. But I wanted to have you on the podcast and have kind of gotten to learn a little bit about you, your fund, and your background. And I really admire what you're doing, because I think ultimately where the blockchain industry is going to be headed, in my opinion, is focusing on applications at scale that make money. And I think you started your firm really ahead of this thesis, predicting kind of like the early days of the internet. A lot of it was speculative, but as the industry matured, these are businesses that make money. And so maybe before diving deeper into your fund and everything, how did you get here, and how did you get into the blockchain industry?
Yeah, and the fund thesis really comes from my background and John, my co-founder's background. We both worked in private equity. I worked in mid-market private equity, buying up companies in the US, and John worked in real estate private equity. But both of those jobs, especially in the mid-market, are based on cash flows of companies, because you're not buying a stock that you can sell in 3 or 6 months, and you can't really play a narrative if you're planning to own something for 5 to 10 years. So the whole job becomes about predicting cash flows, predicting kind of main drivers, and thinking about, what do I get for holding this asset? So that's really how I grew up thinking about investing. And when we came into the industry, we realized that was not the prevailing mental model at all for investments. It was really a kind of a greater fool model, where you say, I'm buying this because I think there is some narrative that's going to double or triple it over the next 6 months, and someone else will buy it. But why are they buying it? To sell it to somebody else, and there's no kind of end to that chain. So, one of the things that you really do on this podcast is talk about first principles constantly. Our view is first principles are, for an asset, are what do you get for holding it, right? You're trading US dollars that you can pay rent with for an asset. Is that because you think you can sell it to somebody else, or is that because that asset will give you cash flows over time that are more than worth the trade? And we think the latter ends up winning over a long period of time. But yeah, so my background's in private equity. I was doing financial institutions, industrials, healthcare, mid-market buyouts. Um, Before that, I studied economics. And then in 2020, I was working at a firm that was doing a few deals in the space. And before an investment committee, over the weekend, I started reading up on Paxos actually. So it was Declaration Partners. They were in the early Paxos round. And I started reading the papers on the space, learning about DeFi, learning about the vision, and was kind of immediately sold. So within a year of that, we were talking about starting up the fund without a lot of knowledge, but with, high hopes.
I think that's probably how most funds start initially. And when did the fund actually get off the ground? Was it 2022, 2023?
So Jan 1, 22, we started with friends and family capital, and it was a little bit of a beta fund. We were trying to figure out who we were in the industry. We really didn't know, we weren't native. And I think there's a lot of pitfalls that come from, I like to talk about the benefits of TradFi, but if you come in with only a TradFi hat, you will get smoked in this industry because you don't know what numbers are real. You don't know what concepts mean, right? They're all kind of hard concepts. And you're not used to the pace of the industry. So we spent a year figuring things out, moving pretty slowly, and then opened up to outside capital Jan 1, 23.
Nice. That was a turbulent time in 2022.
Yeah, it was an interesting time to start.
Yeah. Same for us. I think there was a lot of learning lessons, and I think within the industry, you kind of have to pay your dues, so to speak, just to get to the starting line and the price to play the game.
The price to play the game is a lot of volatility, but you can speed run it in a year like 22, I think.
Yeah, for sure. So the fund got started in 2022, really focused on the first principles of, hey, this industry will eventually scale. There will be material applications, products, services that are ultimately created within the industry. And we are going to do a first principles fundamental analysis, and we are going to buy and own those assets in the fund instead of pure speculation on the kind of like the opposite side of meme coins.
Although I like meme coins for another reason, we can get into that. But the opposite side of meme coins, exactly. The opposite side of narrative tokens, right? Tokens where it's all about the narrative and how exciting that is to people. And we saw something like that happen after 2001. So that's a period we study a lot in tech, where valuations were priced to eyeballs, they were priced to clicks, and you had these monstrous valuations for Yahoo, Pets.com, and the industry just fell apart, as everyone knows, in 2001, but there were multiple attempts at bringing those valuations back, right? The investor base didn't just pack up and leave the day after the bubble burst. They kept on trying to invest the way that they had, and that made them so much money from 1999 to 2001. And it was always a kind of a bear market rally for those valuation metrics. And the thing to do at that point was to focus on who's building a real product here that can build massive cash flows, and people who did that focused on Apple, Google, Amazon, and kind of went on to have some of the best investment returns, ever. And I think that the foundation of that is a belief in the industry. So we come back to this all the time. If you think, and we do, that the industry will take on kind of centralized finance, we're at less than a basis point of centralized finance right now. And if you think that over 20, 30 years, pick a time horizon, you can get to 70% or more, which we do, then there's almost nothing you should be doing other than spending your time thinking about basic principles, fundamentals, and looking for people building for that kind of outcome. Because nothing has more cash than the financial sector. And if you can really get ahead of that, there should be a lot of Apples and Googles and Amazons in our industry too.
I fully agree. And I think whether you're a builder or an allocator, this is probably the highest leverage place that you can spend your time just focusing on it. Because if you can understand the nuances, how the applications ultimately come together, to your point, it's such a small fraction of what we think it will become. And if it actually does kind of digitize the current financial system, there's tremendous amount of upside, and we're really at the precipice. We always say that things haven't just started, but I truly do feel like that. If you look at user metrics, if you look at on-chain metrics, they're starting, and I think a lot of that has really been focused on infrastructure in the past correctly. But now I feel like infrastructure is getting to the point where you can actually start to build applications, and those applications don't have to worry about as much on the infrastructure itself. So maybe my question to you is, I think like the dot-com kind of boom and bust, everybody wants valuations to be high, at least on the venture side, so that their venture books are marked up, their limited partners feel happy, and they can ultimately sell and go raise another venture fund. But on the flip side, everybody wants to kind of have fundamentals analysis so that they can value these things, and you get the TradFi kind of traditional capital allocators to come in and kind of grow the pie, so to speak. And so there's this weird kind of dynamics today where like valuations generally are still high across the board on kind of a fundamentals point of view, but people want them to be high and don't really want the music to stop. How are you kind of thinking of this when you're either allocating, or how the space shakes out in the next 12 to 24 months?
Yeah, so I think there's like two groups there in your attention, right? One is builders. And I think for builders, you're just encountering the normal kind of revenue conundrum that every company has. You want valuation to be high. You think it's ultimately based on revenue. Go get more customers, earn more revenue, right? Revenue at the end of the day is what your customers are willing to give back to you from the value you created for them. So that it should be fully aligned on the builder side if you can think out 3, 5, 10 years ahead. And you've seen some of the best builders over time think about kind of customers and revenue as their North Star. Then there is a group of investors who want to make money quickly, raise a new fund. And I think it's hard to do that because revenues take time and fundamentals take time. You know, I think back to one of my favorite lines in a value investing book by Seth Klarman, where he says, at the end, he goes, "This won't make you get rich quick, but maybe you can get rich slowly." And I think that's our mental model for investing in these markets. If you're making, I mean, these returns can still be way above the cost of capital and way above what people are making in traditional markets. It just might not be 1,000% in a year if you're trying to do fundamental-based investing. And it might still be, right, once you get up the S-curve. But I think the shift, the focus on narrative has been because of precisely the tension that you described, where people are trying to return the fund in a single year, go raise fund 2. It's a little bit of a distorted view of what's reasonable in fund land. And I think it comes from how many people did earn those amounts of wealth in 2017 and 2020. You know, if you're still here, you saw it happen twice, you're thinking, I can do it again, but maybe you can't do it again, right? Maybe you have to think a little bit longer term.
Yeah. And so I guess when you're kind of thinking about the space, you're not really looking at the assets that have kind of the higher valuations. It's the teams that have either done a token and are starting to kind of have a more mature product, or at least some types of cash flows where it's able to justify a valuation long term, I guess, so to speak.
Yeah, or what we call a good faith model. So fundamentals, I think one of the kind of nuances, it doesn't have to be low price. It isn't low price earnings, right? It's just that you're valuing something based on future cash flows. So if somebody comes with a great idea and says, I'm not going to earn any cash for 5 years, but over the years 5 to 15, I should be able to earn tremendous amounts of cash, and it more than pays for your investment many times over. If you believe them, that's a fundamental investment in my book, right? It's not, I think people will often say, low price of sales doesn't work well in the industry. Well, yeah, because if you're buying something that's being disrupted fully and it's going to be gone in 6 months, buying it at 5 times price to earnings doesn't mean anything. You overpaid based on fundamentals. So it's what we call a good faith model. Can you show me a model where the cash flows that come back to the token are more than what we put up plus our cost of capital, plus some for, to make it interesting? And if you can do that and it's believable, that's a fundamental investment in our view.
I like it. I do think I've been talking with more and more asset allocators that have started hedge funds or kind of underwriting digital assets now. And as we've kind of talked about, I see this shift on the horizon.
Yeah.
And everybody can kind of see this tidal wave coming. Everybody wants it to be a fundamental driven market, but then there's this like long term where at least historically the venture capitalists don't want these marks to come down. And so I do think it's very interesting where the industry is probably going to be headed over the next 12 to 24 months. I don't know how long it's going to take for this to play out, but I kind of view it as the natural progression that will ultimately is needed for the industry to move forward.
Yeah, so do I. And it's a good time to get ahead of it, both as a fund and as a builder, right?
Yeah.
So there are so few builders thinking this way that the competitive set is really small if you do want to think about just building a fundamentally based good business.
Yeah. 100%. So maybe shifting a little bit more, I think that maybe paints the picture for the audience of kind of your unique point of view on where the landscape is going from the like overarching blockchain side, ultimately a return to fundamentals, which I think is warranted. And then I think it would be a little bit more interesting if we dove deeper into your fund's thesis.
Yeah.
And yes, it is fundamental driven, but everybody kind of has their circle of competence, so to speak. Can you kind of walk us through some unique areas that you're really excited about? Or
Yeah. So, I mean, we're just generally focused on what we call the internet financial system. You know, people have different words. I don't like the word DeFi. People call it on-chain finance, but just generally the idea of building a replacement financial system on the cloud. We think this is better for many reasons. One is the kind of global angle, right? Having seamless value flows across the world. The other is just what you can do with composability. A lot of Solana's thesis, a lot of what you talk about really hits on that. There are kind of unique financial primitives that you can create with an on-chain financial system that you can't create with the analog financial system. And then there's just the idea of reducing costs, right? Every cost except for trading. Trading stocks is really efficient in traditional markets. Almost everything else can be much better. So we kind of have the view that over 20 or 30 years, that's going to really play out in a big way. And it's a complicated topic. So we like to just spend 12 hours a day, every day, thinking about on-chain finance and how it's going to develop over the long term. So that means we stay away from a lot of interesting areas. You know, a lot of circle of competence is saying no to things. So we actually stay away from DePIN, even though I think it's a great sector. We stay away from AI, even though I think it's interesting potentially in the future. But we just focus on on-chain finance. So, yeah, I mean, there's a lot of things we can get into there in terms of what we see coming.
I mean, it's interesting because for me, one of the first things that really resonated with me on kind of the blockchain side was that decentralized finance aspect, the fact that it is permissionless. The kind of first world is very accustomed to many financial services that are not really as widely available in the rest of the world. And I think you kind of share that with the global finance, because not only is this digitizing services from the financial markets, but it's making them globally available, which I think only increases kind of the market size that we originally thought as well.
Yeah. And I think we can do a lot more, but if all we ever do is bring the efficiency of the US system to the world, that would be a huge win, worthy of all our effort and much more. But so I actually grew up in Central America, some stats on that, where you really see the financial system fail. You know, banks in Central America have earned over 40% ROE over 30 years. That's 4x the ROE of banks in the US. And that's just a pure tax on the economy based on how few banks there are and how little competition there is between them, right? 25% of the Northern Triangle's GDP, so that's Honduras, El Salvador, Guatemala, comes from remittances. Those remittances have 10% fees on average. So you're talking about 2.5% of GDP being taxed by a handful of institutions. And something that you could do on Solana, you know, sending USDC directly for a penny, or a fraction, as you know better than me, fraction of a penny. And then there's just ideas of capital formation, right? Mortgage rates are often way above the mid-teens in these places. Auto loans are they've been above 40% for many years in these places. Like, you're talking about real financial inefficiencies. And if you own a business, guess what? You're never going to sell that business unless you happen to live through one of those kind of global M&A waves that happen every 20 years. That's it. Your business gets passed down to your children, but you have no liquidity. So there's all of these kind of major inefficiencies blocking what's possible. And I think that's kind of what our fund thesis is. We can do all of that and kind of bring the U.S. financial system to the rest of the world as a first step, and then just make it much more efficient as a second step.
Yeah, there are many inefficiencies, and I think I really do just get so excited about what is possible over the long term, and that the technology is just kind of getting to that point. And I think when we first met and we had a dinner and we were kind of nerding out on some of the cool new technology process, and some of that was just talking about as blockchains get better, as you get faster block times, you don't reduce MEV, maybe you reduce the amount of MEV per block, but it's ultimately part of the process of bringing this technology to the world is figuring out the inefficiencies in blockchains as well, and trying to mitigate those or improve upon those as much as possible.
Yeah, we were talking about the Malemi paper on block times MEV. So we love Solana DeFi for this reason. We think the block times and expenses are going to be kind of the determining factors for on-chain finance and what's possible. That paper, just to kind of rehash it, says that at specifically LVR, which comes from SEX to DEX MEV, is reduced quadratically as block times get shorter. So you cut the block time in half, you reduce it by 4. The prediction was that kind of L2s in Solana and fast throughput chains should have much lower MEV, and that's played out for the most part. It's not perfect because you have base fees, and that throws a little bit of a wrench in it, but it's played out pretty much that way. And I mean, that's a huge tax to the system, right? Like SEX to DEX arbitrage, or just general MEV in general, there's no such thing as benign MEV. It's always a tax on somebody, right? It's a system that conserves. It's like conservation of energy. If it comes from if the ARB is making profit, it's coming from somebody. It might be wider spreads. It might be a user that doesn't know they're paying for this MEV, but it's never, it's always zero sum, right? So reducing LVR by 4 every time you cut block times in half is a very meaningful reduction. So that's one of the things that we're excited about. Other things on the high throughput kind of thesis that you have in your fund and your podcast, there's really interesting designs. Like, I don't know if you've ever gotten into the LP options idea. Like, you can take LP shares. LP shares are basically covered call options, right? So you're introducing this convexity into financial instruments that we just don't have on chain. On chain, we have spot and perps. Those are both, in the kind of parlance, they're delta, but they're not gamma. They're straight lines, but not convexity. But you have LP shares, right? And those have this kind of convex shape. And there's all these ideas about how to use those to make all types of any option, really arbitrary options. And the idea works in theory anywhere, but immediately you see costs blow up because you're rebalancing constantly. You see costs blow up if you're paying any kind of gas fees at all. So there's just all these ideas that are really kind of only possible with composable finance, but they don't work unless you have fees kind of down to fractions of a penny, and block times down to hopefully faster than 400 milliseconds.
I think we can get there. It'll take some time. I've been excited about kind of the general progress of the high throughput ecosystem. Solana, obviously, kind of spearheading that. Some cool things going on the consensus side with Sui and Aptos. We'll see what happens with Monad, but it's definitely an area to kind of keep an eye out. So maybe staying on the topic of MEV, what are your thoughts around like MEV value accrual for like different blockchains? this is kind of the prevailing narrative at the moment.
Yeah. So it's Tushar's argument from like 2 years ago. I think it's a brilliant argument. I was happy to see it because it's kind of bringing things down to fundamentals and cash flow. Ultimately, I don't actually think it works after thinking about it for a while now, because you are putting something that is just negative for the ecosystem at the heart of its value, and that just leads to all types of, silly conclusions, I would say. For example, sorry, go ahead.
So I think you have like different types of MEV, the good MEV, which is like the sex stacks arbs, and then you have like the bad MEV, which is like the sandwiching attack. Do you feel like it's for the ecosystem, like trying to remove all the MEV, or?
So I would argue that there's no good MEV.
Okay.
It's always a tax, right? Somebody who wrote a script and lives anywhere in the world, can interact with nobody from the ecosystem ever, is earning money from the participants in the ecosystem. And, if that's what the rules allow, nothing against it ethically, that's fine. It's a way to make money, but it's always a tax. It either results in higher borrow costs. If it's, liquidations, it results in wider spreads. If it's an exchange, it has to come. It results in worse execution prices for customers. If it's a Telegram bot, and look, we have investments in these areas. If the cash flow is there and we think it's going to stay, we're happy to invest in it. But I think as an ecosystem designer, you want to reduce this number to the lowest number possible, because it would just be the best customer experience for everybody who's a real part of your ecosystem. And I think having the model that MEV is the basis of the token value leads you to conclusions that I just don't think anybody agrees with. Like right now on Solana, there's a lot of sandwiching, right? It's I think the major component of MEV on Solana right now. And the model would tell you that protocol devs might look at that and say, we don't want to reduce that because then the value of Solana would go down. And nobody believes that, right? The other problem with that model is I do think ultimately all MEV goes to the applications, or the vast majority of it. You're seeing that right now with things like Oracle extractable value, where oracles and lending protocols are splitting liquidation fees. That's just the beginning, right? You're seeing it with kind of Uniswap v4 hooks, where LPs and users are able to split the top of block sex to dex MEV fees. You're just going to see that more and more, right? Because who owns the customer at the end of the day? It's not the validator. The validator gets to decide what goes in the block or not, but they're way downstream, right? Upstream, you have customers interacting with applications, and they have found ways to take that MEV, and they will continue to find more and more ways to take that MEV over time.
Yeah, it is interesting because originally the argument for kind of like the app chains was, oh, you need an app chain to capture the MEV because otherwise you don't get any of the MEV. And I think that's kind of been proven false and will be continued to be more false over time, where applications can encode logic to capture more and more of that value if they create a useful application.
Yeah, I fully agree with that. Maybe that was true at the time, but it's certainly not true now, and it's not true. It won't be true over time.
Yeah. So I think, yeah, it is interesting because, I mean, whether like the different order flows that are starting to emerge on chain, these private order flows, whether it's trying to continue to experiment with the new items, as you mentioned. What I've always been excited about with DeFi is potentially bringing all these people on chain. And then now I think we have the inklings, but now we have to quote tighter spreads. We have to add more liquidity and build out all the necessary pieces to continue to get us there, to convince more and more people to actually come on chain.
Yeah, I agree. Although I would say there's been a quiet Moore's law on chain for the past, since it started really, but for the past 3 years certainly. The things that we were looking at, because we started only looking at on-chain protocols, the things we were looking at before, focusing on cost and speed, are just dramatically different now, right? Like if you want to trade on perps, on chain 3 years ago, you were looking at 25 basis point spreads or more. Uniswap, when it started, was quoting 80 basis point spreads all in for ETH USDC. Now you're looking at kind of 1.5 basis points for perps, between that and 5 basis points on Uniswap. Like, that's Moore's Law type of advancement, right? And we're seeing that across the board. So I really do think we're well on our way. It's just been we're well on our way with not that many builders focused on kind of financial primitives.
Yeah, I agree. It's an exciting time.
It's an exciting time.
So I know you have the TradFi background. You're really deep in the weeds on the traditional finance markets and also ultimately how that converges with kind of blockchain rails. Are there any other areas of focus that you and the fund like to explore or like learning more about?
Well, we always like learning more about what's going on in infrastructure, but only to the extent that it tells us, what's going to be possible with on-chain finance. So, no, I think the core of our philosophy is focus. Anything that's adjacent is worth reading about or learning about because it impacts your kind of circle of competence. But, I think a lot of investors across history have lost a good thing because they lost focus. And I think it's kind of 10x is true in this industry, where there's always something more interesting to look at. There's always good yield somewhere. There's always some interesting narrative. And if you don't really kind of tie yourself to the mast on circle of competence, it's easy to get directed there.
Yeah, I was talking with Kyle Smonity from Multicoin a while back, and his advice to new fund managers was know your area of competence and kind of know your strike zone.
Yeah.
And I think saying no is kind of a superpower. You don't have to swing at everything.
Yeah.
And focusing is very important.
But within on-chain finance, there's so much going on, right? Like, one thing that's really been covered lately that we've been excited about for a while is prediction markets and decision markets. That's such an interesting, it's almost, there have always been prediction markets, but really bringing them to a global scale could be so meaningful, right? People have obviously seen what's happening with Polymarket and the election, where it's been ahead of the news cycle by hours or even days, or even weeks, I think, in one case. And then I don't know if you've looked into decision markets. That's where FutureKey plays. I know their name's been around for a while. So it's the idea you can say, Uniswap is going to potentially turn on a fee switch, right? And then you make a conditional buy. You say, if they turn on the fee switch, then I'm willing to buy Uniswap at, this price, $6.50. If they don't, I don't want to know. So you, as an investor, you can actually take off a whole portion of the probability tree and only make a decision based on one part of it. And the idea is, for investors, it's great because you get to kind of just refine your views. And for the social benefit is it then signals information to decision makers, right? You kind of see in the Uniswap case, the market thinks our price would go up if we turn it on, and here's precisely the spread. The classic example is a decision about firing a CEO, right? So the market tells the board, what the stock price is with the CEO and without the CEO. And I think if you just kind of amplify that, it starts to get really, really interesting what you could do with kind of markets and predictions.
I agree. I like Polymarket. I think it's been very interesting with the election. I hope they can continue the momentum and continue to expand that outside of politics after the election is over, because they definitely have product market fit for the election. We'll see if they can continue to expand that afterwards.
It'll be lumpy, probably.
Yeah,
is my guess.
Yeah.
It'll be hard to beat this year, next year.
Yeah,
but
hopefully
that's the nature of things.
I think kind of some of the things that you're touching upon, though, really kind of flags or ties into how you guys underwrite things and think about markets holistically. And we kind of touch upon it in the beginning. I think this, though, we should probably double click into, because it is really core to your thesis, the fund, and just being very fundamentally driven in a market that historically has not been.
Yeah. So this is what we spoke about a little bit earlier with kind of a good faith model. We think the entire exercise comes down to making a prediction and being right. So the model, in a sense, is your prediction. And you say, here it's always cases, right? It's all probability. So here are the cases that I see for this company over the next 3 years. And I say 3 years because there is a limit to predictability in this industry. Things move too fast. So trying to make a 10-year model, good luck. We always say they're not tire companies. So you really are at, there's just a lot more uncertainty.
And
right?
maybe like to clarify, when you're underwriting these things, it's not like the traditional TradFi markets that are looking to like underwrite something to like a 10 or 20%. You guys are underwriting to larger outcomes.
We're underwriting to 5 to 10 times over 3 years. That's what we think is our cost of capital. PE firms do reliably make 2.5 to 3 times over 5 years, but their hit rate is above 90%. Right? If they're wrong, because they're making 0.9. They're never kind of making 0.3. Which is possible in this industry if you're wrong. And 2, they're just right more often because you're kind of underwriting to a tire company growing 3% a year in its major, 4% in the best locations. And you have 15 years of history to prove that's the trend. So it's just, if you can get 2.5 to 3 times returns off that level of predictability in a kind of established asset class, we think we need to make 5 to 10, underwrite to 5 to 10, then we're right hopefully 70% of the time, and we're getting 3.5 to 7 really in 3 years.
That would be crazy returns because I think, for traditional venture markets, a good venture fund, which has a duration of 10 years, is generally a 3x, and you're great if it's a 5x.
It's great returns, but we haven't proven them. Well, we have a few years of trajectory, but we haven't proven kind of the thesis fully. And 2, we're trying to convince people who generally are afraid of the industry, right? So it would be great returns, but I do think that our cost of capital is around those areas to really kind of get.
I definitely agree. I just I think it kind of underlies how quickly the industry is growing.
Yeah.
And that capital generally comes in. It comes in, explores, and I think the more that we have the underlying fundamentals, the more it'll stay. Yeah. And it has been lumpy in the past because you get these periods of hype and excitement, which I think are productive in the sense that it allows us to bring new capital in, raise new venture funds, fund these things to get us to kind of the next iteration that allows us to continue to experiment.
Yeah.
And then reinforce the fundamentals once they actually hit scale.
Yeah, and I think telling the fundamental story will be easier to most of the capital in the world than the stories we've been telling so far.
So do you think we have a retry of 2021 this go around?
We'll see. I think we spoke about this a little bit before the podcast. We try to not forecast macro too much. It's really hard, right? We're not macro geniuses. And even if you think you are, the probability is usually you're not, right? There have been kind of 5 macro investors who have done well over a career that I know of. Maybe there's 10, but it's a small number. And usually they're much smarter than I am. And we just think the kind of token picking game or asset picking game is much easier because I've seen a lot of people do well picking stocks or picking companies or doing venture, thinking about fundamentals. So our view is macro is fun to think about, but not something we underwrite to or really try to predict too much. So I think the answer, long way of saying, we'll see.
Yeah. It has been interesting, just the booms and busts. 2021 was obviously extraordinary circumstances for a variety of reasons, but 2022 was kind of painful and deleveraging from the blockchain standpoint with Luna, with FTX. 2023 kind of we were licking our wounds and excitement kind of coming into the beginning of the year. It's when these things kind of move violently in both ways. Again, are you guys just really just kind of maniacally focused on underwriting these assets, making sure that they're producing or eventually can produce some types of cash flows?
Yeah.
And don't pay attention as much to say like, oh, we're in a bull market, we're in a bear market, et cetera, et cetera.
We only focus on it when we're thinking about kind of entry multiples, you do want to know, you do have to shade whether it's kind of a mid-cycle multiple or a top of cycle multiple. So, if we're kind of looking at Banana Gun, one of our investments, the meme cycle does matter for fundamentals, right? Or kind of with something like Camino, SOL price and activity does matter for TVL. So these things do drive fundamentals. So it's not to say that we don't think about them at all, but we just like to be able to underweight kind of the cycles and think about the long-term vision, what people are building, and how that matters for the company. I wish I could not think about it at all, but it's not possible, unfortunately.
True. And you mentioned in the beginning of the podcast, we were kind of talking about being on the opposite side of meme coins a little bit. And I think that every quote unquote cycle has a unique thing emerge. And I think meme coins have kind of come back with vengeance.
Yeah.
What are your thoughts on kind of the meme coin arc currently?
Well, I think they're fun, right? I think they're kind of positive, not positive EV, but they're better lotteries than lotteries, right? Lotteries do kind of the Powerball billions. The whole point is getting to $1 billion so you can advertise well, and then people have this kind of infinitesimal chance of winning. Whereas meme coins in an upcycle, your odds are much better than that, right? And most people don't want to win $1 billion. They want to win a smaller amount of capital. But the reason I said I like them is because they do kind of help, the fundamentals thesis progress. Everyone has the same sample bias. Everyone who has a group of friends who are in the space trading kind of narrative tokens in 21 has that same group of friends trading meme coins this year. And they don't care at all about our narratives and our technical arguments, and they shouldn't, right? It's for them, it's really boring. For me, it's interesting. For you, it's interesting, but for them, it's really boring. And two, you have this kind of VC unlock schedule working against you, right? If you're buying a pure narrative token, there are sellers into that are kind of on the other side of the table from retail that just wants to buy an attractive lottery ticket. Meme coins, they do have that. Obviously, there are some people always try to include those things, but for the most part, they don't have the same amount of tokens unlocked and investing schedules. And I think to the extent that group of buyers, retail, kind of speculative, high risk on retail, goes away from the narrative tokens, it forces us as investors to look at fundamentals, and it forces protocols and builders to build towards fundamentals as well. So I like the meme coins as removing demand from what I think of as kind of the wrong part of the market.
And I think this also touches upon kind of venture capital ultimately needs to fund tokens that build sustainable projects or services. And I think part of that's not launching at $1 billion FTV unless that revenues or product justifies the billion FTV.
Yeah.
And allowing both liquid funds and retail to potentially participate in that upside. So when the token does a TG or officially comes live, it's not down only, the chart looks terrible. People are excited that it's coming out. They're excited about using the product and it's sustainable.
Yeah. We talked about our cost of capital, right? We have to be able to underwrite to 5 to 10 times returns on our investments. And that's not because we're being greedy. It's because that's what we need to tell our investors to get liquid fund capital in. If you're launching off zero revenues and $1 billion FTV, we can't underwrite to that. So who's the buyer? That's what we always ask. Who's the buyer? You have 30% of the cap table unlocking over 2 years, let's say. You might be able to get enough kind of podcast appearances to get a narrative and kind of low float buyers, into a rally. But then who's the ultimate buyer for 300 million of unlocks? The only pocket that's kind of big enough is the liquid fund pocket. And more, very quickly, liquid funds are all thinking about fundamentals. So we're strict. We've kind of made it a brand, but everyone's thinking about this on the liquid side. And they're all building their models and saying, I can't buy it $1 billion and expect to sell it at 5 to 10. There's not a lot here yet. Like, it might be a great founders, great company making maybe some revenue, but it's a Series A company, right? So I think that kind of issuing at lower valuations, setting the expectation allows you to do the proper cap table transition. Because what do you want as a liquid token? You don't want, I mean, VCs are great for private markets and for helping you, into launch and when you're an early product. But the reality is most VCs need to sell eventually, right? That's the close-end fund by nature needs to sell. So you want to have somebody who can buy up that supply over the long term. And the only buyers you really want there are kind of the liquid funds because, we have the mandate to hold indefinitely as long as the project keeps growing and kind of something you can re-underwrite. And that's the way it works in traditional markets, right? Apple shareholders have seen it through kind of 30 great years. And there's kind of serious funds that the CFO can go out to and communicate with and say, here are our targets, or here's where we miss our targets, or whatever, and have a serious data-driven conversation about the business. If you're trying to make that demand be all retail on your Discord, you're going to have a schizophrenic token price, and you're not going to have any value from your cap table. There's just going to be people who kind of ship it up and ship it down, but you can't tell that group, hey, here's a 5-year plan or a 3-year plan or even a 1-year plan, and here are the core metrics we're trying to underwrite to. So, yeah, I think I'm biased, but lower issuance prices would be good, and then we'd be happy to buy on day one.
So there are too many. I mean, it's been an interesting conversation on Twitter or X in the last, I would say, 3 to 6 months about there are too many venture funds, and that's historically because during these boom periods, you could bid an infrastructure round, you could do a layer one, whatever it was. These things would be at $1 billion FTVs, and you would have high DPI marks that you could return back to LPs and go out and raise another venture fund. But I think as the asset class is maturing, people are starting to ask, primarily driven by so many new projects launching and such high valuations, who's going to buy my tokens? And so the conversation has really shifted to, hey, potentially there are too many venture funds, or there are too many venture funds funding projects at too high FTV. Should there be more liquid funds?
I think there could be more venture funds and more liquid funds. They just need to be more fundamentals.
Yeah,
that's the underlying issue. People are saying there should be more liquid funds, but the reality is there are not enough fundamentals for there to be materially more liquid funds than there are.
And it probably goes back to venture being disciplined on like, hey, you got to show me these metrics for you to justify this valuation. But today, if you do that, you're going to get left behind. And so it's a very weird dichotomy today where everybody, at least what I appreciate is people are starting to think about these things, especially on the liquid side, I would say, not as much so on the venture side. But the chicken will come home to roost, and
it takes a while because you kind of, if you bought narrative, you got smoked. Kind of Bitcoin ETH and a Bitcoin ETH SOL in a basket of kind of what we call value tokens have overperformed massively. Our basket of narrative tokens over the past 1, 2, 3, 4 years. Since 2021. They've been overperforming constantly. So liquid funds have been learning the lesson through kind of repeated knocks. I think it takes longer on the venture side because you can mark your book. There's this kind of liquid is truth that hits you in the face. Like you can't pretend like you're marking something different. I used to do privates. We could tell you kind of think your mark is X, and someone could say it's Y, but you can just say I think it's X, right? You know that too. So the feedback mechanism is slower, but I think it kind of all flows downhill, right?
At Tesla, they very much encourage us to increase your feedback loop, make that as tight as possible. And so I think it's not only getting the allocators aligned with that, but also the founders. And I think ultimately it's going to be painful, but it's going to be helpful for the entire market, and we will grow from this.
And that's one of the beauties of, people do ask, and it's a fair question, why launch a token at all? Like, is it better is the VC cycle that we have in traditional venture better, where you're private for 8 years or or 15 years? And the answer is, it's a hard thing to answer in favor of tokens, because you have good shareholders who are helping you for a long period of time. Founders don't make too much money too early. I don't think it's good for anyone to make too much money too early, or at least maybe it's good for them, but it's not good for the business that they're building. Same is true for funds, for everyone. So, why launch a token at all? And I think one of the main benefits is this feedback loop, right? You have, if we can actually structure a good disciplined set of buyers on the liquid side, you can have kind of immediate feedback. Whereas in a private company setting, it just takes longer to get that feedback.
And I think the thing that we've also been harping on with the token that's beneficial is just that global nature. Not having it only be US bound, having a global audience, all the benefits that blockchains kind of provide.
Yeah.
And I think it's also nice that like potentially tokens can go live at a couple tens of millions, hundreds of millions of FDV instead of kind of the tens billions that historically the IPO market has had, because it was nice kind of looking historically all these companies coming out in hundreds of millions of market cap. And today that's just not the case. And so Uber, came out at 50 billion or something?
Yeah.
So it'd be nice for the retail people to ultimately participate in some of this upside as well.
Yeah. And to your point, global, right?
Yeah.
The number of people in the world who want to own Apple stock that just can't because their local broker doesn't let them is astonishing to people.
So I want to shift the podcast a little bit to some things that you're personally excited about, or potentially even hold within the fund, kind of on this theme of focus on the fundamentals, potentially can produce lots of cash flows in the future.
Yeah, great. So I'll just talk my book, if that's okay with you.
Please do. Show us your bags.
Yeah. So I guess, one thing I'll say up front is we do take a very kind of activist partner role with all of our companies. So these are all companies that we kind of speak to constantly, and kind of have grown to really care about both the teams and the visions. But maybe to hit on one, and kind of get to the underwriting, kind of the way that we underwrite as an example, would be Vertex. So Vertex is a perps protocol. It's on EVM now, but I think their vision for perps is it doesn't matter where you are if you're on chain. Because if you have off-chain matching, on-chain settlement with a ZK proof that you matched and liquidated according to your docs, you don't have to. You can be on every chain without being on any chain, and actually have liquidity across chains cancel out, right? So you kind of have native cross-chain liquidity, and you have, much faster time to settlement than you can have on any one blockchain. So even Solana is the best that we have now, right? I think the best case I've seen in Solana anyone mentioned is 100 milliseconds. Maybe it can be better than that, but that's still a lot of adverse selection for perps, for derivatives. Their vision is you want to get that down to kind of 5 milliseconds, and that that just makes for tighter spreads. It just makes for kind of the elimination of all of these predatory strategies that are possible when you have long block times. And you can only do that with this kind of off-chain matching, on-chain settlement model. But, Vertex has a great team. And to talk about, they have a good vision, we think. And we fundamentally think that the on-chain economy's kind of first target is the SEX target, is Binance. Because I would love to get the whole world trading digital assets, but the reality is we have a lot of people trading digital assets now. We have a ton of volume. It's just all on Binance. And if all we do for the next 5 years is get that volume on chain, or even a portion of it, there should be enough for a lot of teams to make a lot of money.
Someone tweeted, I can't remember who, and I retweeted it and said something along the lines of like, this chart is the most important chart within crypto.
Yes. Yeah.
And the chart ultimately articulated the centralized exchange volumes to decentralized exchange volumes. And I think it has gone up from like 10 to like 14 or 15%.
And it's up only, basically.
Yeah.
If you look at it on an annual basis, it's up only.
Yeah.
Since Uniswap launched, kind of almost 6 years ago. So that same thing is happening in perps. So perps in 22 were less than 1% on chain. Last year they were 2%. This year they're actually at 4.5% on chain. We think that number is going to 9% over the next 2.5 years, on a conservative estimate. So we're always looking for ways to play that, because these volumes, 9% of perps is, you don't have to think about macro. You don't need any market growth. You can just make really good returns with just that one number. So Vertex is kind of the team that we back there to play that trend. A lot of it's team quality. A lot of it's, we really focus on customer experience, and we found that a lot of protocols in this space were really focused on incentives. And incentives as a way, as incentives and kind of points as a way to get a token up. And then, not every team wanted to stay in the industry, I'd say. And that's something we really try to weed out. The Vertex team, they're missionaries, they're not mercenaries. And that's kind of probably the first question we ask or the first question we ask ourselves in IC. And they're just fast and cheap. They trade at 1.5 basis points on spreads, and then they trade at kind of 10 millisecond matching times. So maybe to kind of double click quickly on underwriting there, because we were talking about it earlier. We have this prediction that the perps market will get to above 8% over 2.5 years of the off-chain market. And we also think that they're going to go from 7.5 to 17.5% market share because of what we see as their embedded advantages. That's our whole model, right? So we talk about models, it could be this complicated thing. The model is just a prediction that you put on paper, right? If those two things happen, the revenue should go from 20 million to 80 million. We bought it, at a low multiple on the 20. And if they're making 80, our investment should be in that 5 to 10 times range on any kind of reasonable exit multiple. So, it's just a long way of saying a model is just a prediction.
Nice. I love it. And I think to your point on the product side, that could be echoed across a lot of teams that are currently building today, is when you have financial experimentation and give people a sandbox to play in, try many things. People want to financialize everything, but I think that's fine experimentation, but the product also still has to be good.
Yeah.
And at the end of the day, if the product sucks, if the UI sucks, people will come and give you free money or take free money if they can, but then afterwards, the sugar rush, people will leave. And so it's good to also know that they're super focused on the product side.
Yeah, and I guess there's, in every kind of incentive cycle, you have to ask, the classic question of, if there's a sucker at the table, and if you don't know who it is, it's you. Who's paying that money? If you're playing that token game, someone's paying for that. I won't guess on air who it is, but someone's paying for it. Money never comes from nowhere.
Yep. Maybe one other that I think we have mutually shared interest in is Metaplex. Can you talk just briefly about Metaplex and what got you excited about the Metaplex team?
That one was a fantastic one. Sad to say we did not discover that one. We learned it from a peer fund, Modular. They're very smart. But that's one where what we call banker work was very important. So banker work is kind of getting a token with mismatched information and no kind of maybe a bad cap table, maybe a bad story to the market, and kind of helping them navigate the public markets, right? Like what investment bankers do in traditional finance is an important role. So they were a monopoly in NFTs, or let's say predominant NFTs, to not use that word. And they're making really good cash. So they're making about 8,500 SOL a month right now, and they have been around that level for a long time. But the markets didn't like them because, one, they had a terrible cap table, right? They kind of raised in 21 from a bunch of celebrities and a lot of people who've left, FTX, and a lot of people who've left the industry since Jump. And two, they didn't always have the proper love in the Solana community, as you know, because of some history. And three, there was no value accrual to the token, and nobody ever knew if there would be, right? So as soon as we made that investment, we kind of sat down with part of the team. We're like, these are the 4 issues we think are holding your token back. They are well aware of it. They have an excellent team, And then you've just seen each one of those get resolved over the last year. Since then, the cap table has gotten much better. It's a lot of names that we would love to have in our other tokens. The good holders, reasonable people who talk to the team and talk about what the best way forward is.
Nice. Yeah. It's interesting on the liquid side. You're really shopping for these hidden gems where there's massive kind of pricing discrepancies. And ultimately, I think in an industry that's run by narratives, the narratives can ultimately be very incorrect sometimes.
Yeah.
And seeding out the bullshit from reality, there is a lot of digging, but Metaplex and the team, I am excited. They kind of had the hype cycle, the bear cycle, and now I hope on the slope of enlightenment.
Yeah, and they actually earn money with every new token create. So they earn monies off meme coins as well, but it's less than NFTs, and NFTs aren't really up from cycle lows. So it's still one where you can be comfortable that the bottom is in, and there's probably significant upside to the core drivers.
Yeah. So maybe as wrapping up, are there any unique things that we didn't touch upon that you either want to share about your thought process, the fund, kind of how you think the space is evolving? I think we've touched upon a good amount, but anything that you want to double click on before we wrap up?
No, I just I'd say the main thing is believe in something, believe in on-chain finance. There's a lot that can be done. We see teams building incredible products and options in lending and long-tail asset lending. Boosted pools are a great idea. I hope they can work one day. There's all these amazing financial innovations that are possible here. And they've kind of been, we talked a lot about infrastructure and some of these VC investments, but the reality is they got us to where we are in terms of what's possible. And if that process hadn't gone on the way it had, we wouldn't have fast blockchains, we wouldn't have low latencies, low fees, and a lot of unique architectures. So it's now there. So and there's a lot of good ideas out there. Just would love to see people who are building those ideas. And there's a lot of people there, but there's not enough.
How can people learn more about you or the fund? Get in touch.
So my Twitter, Theia Research @Theia Research, or Noah's Twitter, Trader Noah. Those are probably the two of us kind of constantly tweeting.
Cool. Awesome. And maybe just wrapping it up on kind of New York. It's been interesting just watching New York kind of become more of a hub for crypto, which is a little weird considering it's not Silicon Valley or other places. And I think that's in large part because Silicon Valley maybe has too much of a crush on AI and kind of shunned crypto for too long, but it's cool to see all the talent here coalesce in New York and a lot of smart people. It's
nice. Yeah. So I live in the same apartment I used to live in when I had my old job in buyouts, and most of my meetings probably have 2 meetings a day within 5 minutes. So for me, it's been nice to kind of join a new industry and realize it was in my backyard in a sense. But it's also just really good energy. People here are constantly meeting, constantly getting after work drinks, lunch, and people who don't live here are here multiple months out of the year. So the first thing I tell people who are kind of younger on the fund side is just move to New York, and then you can figure everything else out.
I did the opposite. I moved to Miami and was like, I need warm weather and beaches to clear my head.
Well, there's
Get
benefits.
Off the computer.
There's benefits to. You can be more contrarian when you don't live in the main city.
That is true. The independent thought. Well, maybe
Exactly.
end it on that. Think from first principles. Think from fundamentals. But really appreciate you coming on the podcast. I think this conversation is only going to get louder and louder over the next 6 to 24 months, and I think you guys are spearheading that. So
thank you for having me.
Thank you.